In 2025, investing in the Philippine stock market is more accessible than ever, but choosing the right investment can still be confusing. Should you pick individual stocks, open a mutual fund, or try something simpler that gives you instant access to the entire market? That's where FMETF, or the First Metro Philippine Equity Exchange Traded Fund, comes in. It's the first and only ETF in the Philippines, and it continues to be a popular choice for long-term investors who want exposure to the country's top 30 companies, without the complexity of picking stocks one by one. But what exactly is FMETF? How does it work in 2025? And is it still a good investment today? Whether you're a beginner looking for a smart way to start investing or a seasoned investor looking to diversify, this guide will help you decide if FMETF deserves a place in your portfolio. What is FMETF and how does it work? FMETF stands for First Metro Philippine Equity Exchange Traded Fund. It's a type of investment fund that's listed and traded on the Philippine Stock Exchange, just like a regular stock. But instead of investing in just one company, FMETF gives you exposure to the entire PSE index, or PCI, which includes 30 of the largest and most established companies in the Philippines. So how does it work? When you buy shares of FMETF, you're essentially buying a small slice of each company in the PSCI, from big banks like BDO and BPI to giants like SM, Ayala, JG Summit, and PLDT. The value of FMETF changes throughout the trading day, just like a stock. This is called its market price, and it's based on supply and demand. But behind that is the NAVPS, or Net Asset Value Per Share, which reflects the actual value of the fund's holdings. FMETF is managed by First Metro Asset Management Incorporated, a subsidiary of Metrobank. Their job is to ensure that the fund continues to accurately mirror the performance of the PSCI. Not beat it, just follow it closely. In simple terms, investing in FMETF means you get instant diversification across the Philippine stock market. You can buy and sell at any time during trading hours. And it's designed to grow in line with the Philippine economy. That's the basic structure of FMETF. Easy to understand, cost-efficient, and built for long-term investors. Key features and benefits of FMETF. Now that we know what FMETF is, let's look at the key reasons why many investors may still choose it in 2025, even with more financial products available today. 1. Broad diversification. With just one investment, you get exposure to 30 of the Philippines' largest and most stable companies. This reduces your risk compared to investing in just one or two individual stocks. For example, if one company underperforms, its impact is limited because you're also invested in the other 29 companies in the index. 2. Liquidity and flexibility. Unlike traditional mutual funds that are priced once a day, FMETF trades like a stock. You can buy or sell shares anytime during trading hours on the Philippine Stock Exchange, giving you flexibility and control over your investment. 3. Cost efficiency. FMETF is a passively managed fund, which means lower annual management fees. In 2025, its annual expense ratio remains around 0.5%, which is significantly cheaper than many actively managed equity funds that charge 1.5% to 2.5%. 4. Transparency. FMETF publishes its net asset value per share daily, and its holdings are publicly disclosed. That means you always know exactly where your money is invested. 5. Simplicity for beginners. You don't need to research individual companies or monitor market news closely. FMETF simplifies the process by mirroring the PSE index, making it ideal for beginners or long-term investors who prefer a hands-off approach. In short, FMETF continues to be a smart, low-maintenance option for Filipinos who want to invest in the growth of the country, without the stress of stock picking. Risks and limitations of FMETF. Of course, like any investment, FMETF isn't perfect. Before you invest, it's important to understand the risks and limitations, especially in the context of 2025. 1. Market risk. FMETF mirrors the performance of the PSE index, so if the index goes down, your investment value goes down too. For example, If the market drops due to political uncertainty or economic slowdown, FMETF will reflect that drop. It doesn't protect you from volatility because it follows the market, not tries to beat it. 2. Tracking error. While FMETF aims to closely follow the PSCI, there may be slight differences in performance. This is called a tracking error, and it can be caused by factors like fund expenses or trading inefficiencies. Thankfully, FMETF has maintained relatively low tracking error over the years, but it's still something to be aware of. 3. No dividends paid out. FMETF does not pay cash dividends. Instead, any dividends earned from the companies it holds are reinvested back into the fund to help grow its value. So, if you're looking for regular income from dividends, FMETF might not be the right fit. 4. Short-term trading risk. While FMETF is traded like a stock, it's not designed for short-term speculation. Because its goal is to mirror the index, its movements will be in line with the broader market, not sudden gains. It's best used as a long-term investment, not a get-rich-quick strategy. Understanding these risks helps you invest with clarity and confidence. And in the next segment, we'll compare FMETF to other investment options available to Filipinos in 2025. FMETF versus other investment options. Now let's compare FMETF to some of the other investment choices available to Filipinos in 2025, so you can see where it fits in your strategy. FMETF versus individual stocks. Buying individual stocks gives you the chance to earn higher returns, but also comes with higher risk. You need to research companies, time your entries, and manage your portfolio actively. FMETF, on the other hand, gives you instant diversification, less stress, and more consistent long-term exposure to the market's overall performance. FMETF versus mutual funds or UITFs. Mutual funds and unit investment trust funds are also pooled investments, but most of them are actively managed, which means higher management fees and possibly higher taxes. FMETF is passively managed, so you save on fees. Plus, FMETF offers intraday trading, while mutual funds are only priced once per day. However, traditional funds may offer more thematic choices, like ESG, bonds, or sector-specific investments, if you're looking for something more tailored. FMETF versus Pag-ibig MP2 and bonds. Pag-ibig MP2 and government bonds are low-risk, income-generating investments. They're great for capital preservation and earning steady returns, but they don't grow as fast as stocks. FMETF is better suited for growth-oriented investors who are comfortable with market ups and downs in exchange for higher long-term gains. So in 2025, FMETF sits somewhere in the middle. Higher growth potential than time deposits, MP2 and bonds. Lower risk and complexity than stock picking, and often cheaper and more flexible than traditional mutual funds. It's not about which is best. It's about which fits your goals and risk tolerance. Now let's talk about common mistakes Filipinos make when investing in FMETF, so you can avoid them and get the most out of your money. 1. Expecting quick profits. FMETF is not designed for short-term trading. It tracks the overall market, which means growth is gradual, not explosive. If you're expecting overnight gains or big price swings, you'll likely be disappointed. 2. Panic selling during market drops. One of the worst mistakes is selling when prices are down. Markets naturally go through ups and downs, and FMETF moves with it. The key is to stay invested long-term, especially if you believe in the Philippine economy's future. 3. Ignoring the NAVPS versus market price. FMETF has a net asset value per share that changes daily. But since it's traded like a stock, its market price can sometimes be higher or lower than the NAV. Always check the NAVPS on the First Metro website before buying, so you don't overpay. 4. Forgetting about broker fees. You buy FMETF through a broker, so transaction fees apply, usually around 0.25% to 0.5% per trade. These fees may seem small, but they add up if you're buying and selling frequently. Avoiding these mistakes helps you stay on track, and lets FMETF do what it's meant to do: build wealth over time. How does FMETF compare to global ETFs like VOO and SPY? In 2025, more Filipinos are opening accounts with brokers like eToro, IBKR, and GoTrade. So it's a fair question. 1. Market exposure. FMETF gives you access to the Philippine economy, which is growing but still developing. Meanwhile, global ETFs like VOO track the U.S. stock market, composed of tech giants and global leaders. If you want exposure to international markets, global ETFs offer that diversification. 2. Volatility and currency risk. FMETF moves with the PSE index in pesos. Global ETFs move with foreign markets, and returns are affected by exchange rates, which adds both risk and opportunity. A strong dollar can boost your returns, but a weakening peso may hurt you when you cash out. 3. Fees and accessibility. FMETF is easily accessible through local brokers like COL Financial or First Metrosec. Global ETFs require foreign brokerage accounts, which come with dollar conversion fees, tax forms, and possibly withholding taxes on dividends. So what's the takeaway? If you're just starting, FMETF is a solid, accessible choice. But as you grow as an investor, consider adding global ETFs for international diversification, so you're not tied to just one economy. FMETF can be a core holding, and global ETFs can be the next step in building a truly diversified portfolio. So the big question is FMETF still worth investing in this 2025? The short answer is yes, if your goal is long-term growth and market exposure. As of 2025, the Philippine Stock Exchange Index continues to be a benchmark of the country's largest and most resilient companies. FMETF remains the only exchange-traded fund in the Philippines that directly tracks this index. That means when you invest in FMETF, you're still riding on the long-term growth of the Philippine economy through companies in banking, infrastructure, real estate, telecom, and consumer goods. Despite market fluctuations and global uncertainty, FMETF continues to offer strong diversification, low management costs, liquidity and transparency, and a simple, passive way to participate in the stock market. It's especially attractive for Filipinos who want to invest but don't have time or expertise to research individual stocks. However, it's still not for everyone. If you're looking for guaranteed returns, regular dividends, or capital protection, then FMETF may not meet those specific needs. But if you're in it for the long game and you believe in the potential of the Philippine economy, then FMETF is still a solid option in 2025. If you got value from this breakdown, don't forget to like, subscribe, and share this with someone who's looking for a simple and diversified investment option. Until next time, invest wisely and stay thrifty.